In today's video, we are going to be breaking down the Royal Bank of Canada. It has recently become the biggest company in Canada on the Canadian stock market. It just surpassed Shopify, unless, of course, Shopify, by the time of posting this video, starts having their share price go back up. But either way, Royal Bank of Canada is currently, at the time of making this video, the biggest company in Canada. Let's get down and let's check out this company, see if it's worthwhile our investment. So it is currently, at the time of making this video, being traded at $116 a share, down $1.30. Not looking so good today, but usually on a down day, it's a good time to buy. You want to buy when people are fearful. You want to sell when people are excited. So from there, what we want to look at is the average volume. And at the time of making this video, the average volume is 4.8 million shares being traded every single day. From there, what we want to look at also is the forward dividend. And of course, at the time of making this video, it's $116 a share, which means that it has a 3.7% dividend. That's pretty good. Now, Royal Bank does pay it out quarterly, so basically you would be dividing that by 4 and it would be being paid out every single quarter, which is pretty good. From there, what we also want to look at is the PE ratio, price to earning. Now, you want to compare this up against other Canadian banks. You wouldn't want to be comparing this number up against other sectors. For example, Shopify is in the 500 range, while we have the banks generally sitting around the low 14s and high 13s, which means to me that this is in line with the other Canadian banks, but I usually personally prefer to buy the Canadian banks when that PE ratio is a little bit lower in the 10, 11, or lower range. Right now, I would not be buying a ton of bank stocks, but I would be dabbling in a little bit with them if I had spare money on the side to do so. I currently do own Royal Bank of Canada. I basically own all of this top 6 Canadian banks, the big 6 they call them. So I guess you could say that's a disclaimer. With Royal Bank, I was grabbing it right about here. Before this point in time, I was not owning Royal Bank of Canada. However, I did own other shares like National Bank as well as TD, BMO, not Royal Bank, Scotiabank I had all of them except for Royal Bank up until this point in time. Now, when it comes to the stock, it did sort of stagnate. It did have a little bit of growth over the last couple of years. However, when the coronavirus pandemic hit, that is when it was a fantastic buying opportunity. I was buying companies like CIBC and TD down here, which was fantastic. And since then, it has exploded upwards, which is concerning a bit. So of course, our housing market in Canada has also exploded with inflation. That's what I'm calling it. I'm calling it inflation. Now, will the housing market continue to go up? Will it dip? It's hard to say. Do I think it's going to dip in cities like Toronto? Yes. But all of the surrounding cities like Hamilton, Burlington, and all of them, I think their prices are going to continue to go up because nobody really wants to live in the big city anymore. So that is a bit concerning for anyone who's trying to get into the housing market. What about interest rates? Well, when interest rates go up, usually housing prices go down, but the banks make more money, so it's kind of a flip-flop. From there, the banks, however, no longer just rely on interest rates. They are now almost like a monthly subscription style investment where now when you invest in Apple, you're not investing in the company to bring out a new product. You're investing it because it has that residual income from their cloud services, their music, their TV, all of that stuff. Now, when you invest in the banks, it's starting to become like that because with banks, they're offering different mutual funds as well as different ETFs that are bringing them in an MER, and investing is becoming more and more popular. And then also they have their cost of doing business with them. For example, if you have a bank account, you most likely pay them a bank account fee. For example, myself, I'm with TD. I need to keep at least $5,000 in my checking account so that I do not pay $40 a month to have my account. But that account also gives me a free $120 a year credit card, while other people, they may have to pay for that credit card. They may have to pay for those fees. While I don't have to, other people are. And especially with the pandemic and people's money getting shorter and smaller, there's going to be more and more people getting or having to pay those high fees for those bank accounts, which really sucks for them, but really good for the banks. And then when we also look at the dividends have grown for a long time. They started off back in 2016 at 81 and 83 cents a share. It is now looking at $1.08 per share. And that is just going to continue to grow because now these banks are making more and more money. They have to grow their dividend because they want to be able to share that wealth with their investors. And of course, the reason why I really enjoy investing in the Canadian banks and why you should as well is because at one point in time, every single one of us had to pay a bank fee. And to get those bank fees back, obviously you could just stick a ton of money in those accounts, which I do, but you can also invest in their bank so that now you essentially just get paid back eventually. So that is a great way to kind of look at these investments. Now, from there as well, I also want to say that all of the Canadian banks, the big six anyways, have paid a dividend for over 100 plus years, and they have grown their dividend over 100 plus years. There has not been one instance where they totally stopped or declined their dividend. They have paused growth of dividend, but they have never stopped paying a dividend. So for example, right now, they are not able to raise their dividend. However, they can still pay what they've been paying in the past. Now, if we look at their earnings growth, they have had a bad quarter in Q2 of last year, which there was the coronavirus pandemic, but that is a bit concerning since many other Canadian Big Six banks never had that issue. However, at the same time, they did have 3 quarters of growth, 3 quarters of good, solid earnings, which is fantastic, and I think that's going to continue on May 25th, but that's just me personally. We've also seen a rise in revenue over the past 3 years, not including 2020. 2020 did have a little bit of a hiccup, but again, so did everybody because of, the virus. So from there, also earnings was still positive, which is good. This is concerning for me, however, with Royal Bank, because many other Canadian banks did not have that issue. Those 2 issues were not shared by every single bank. And personally, I am looking at banks right now that did not have this hiccup. For example, one of them was National Bank. National Bank has had really solid earnings the whole entire time. So that is my take on the Royal Bank of Canada. I would love to know your thoughts down in the down in the comments below. I almost said description, but anyways, I hope that you enjoyed today's video. If you have, hit that like button and subscribe. Remember, don't always trust a random person online. Always do your own research, and I'll see you guys again next time.